Thinking about offering seller financing to sell your business, it can make your business easier to sell, attract more buyers, and even get you a higher price. But if you do it wrong, it can turn into a complete nightmare. In this video, I'll break down what seller financing is, why it's so powerful, and the biggest mistakes to avoid so you don't get burned. Let's dive in. What is seller financing and why it matters? Seller financing is when you, the business owner, finance part of the purchase price for the buyer instead of them paying 100% upfront. This means the buyer makes a down payment and pays you the rest over time, typically with interest, like a loan. So why is this important? Because many buyers can't or won't pay the full price upfront, and banks don't always fund business purchases 100%, especially for smaller businesses. When you offer seller financing, you increase the pool of buyers interested in your business, you speed up the sale, and can often get a higher valuation because buyers will pay more if they don't need to come up with all of the cash immediately. Let's talk about the pros and cons of seller financing now. Well, number one, it attracts more buyers. Buyers who can't get full bank financing can still make offers. Number two, you can sell at a higher price. Since buyers don't need all the cash up front, they may be willing to pay a premium. Number three, it's a faster time to close. Fewer financing hurdles means deals move quicker. Number four, potential for interest income. You're earning interest on the finance portion, increasing your total return. And number five, it shows buyer confidence. Offering financing signals to buyers that you believe in the business's ability to perform. Now, what are the cons of seller financing? Number one, risk of non-payment. If the buyer doesn't pay, you might have to take back the business. Number two, there's a longer payout period, right? You won't get all of your cash up front, so if you need a lump sum, this might not be the best deal. Number three, potential buyer mismanagement. If the new owner runs the business into the ground, it could impact their ability to pay you back. Number four, legal and documentation complexity. You need a well-structured seller financing agreement to protect yourself. So here's how to avoid seller financing nightmares. Number one, require a strong down payment. Never finance 100% of the sale. Require at least 30 to 50% down, if not 70 or 80%, to ensure that a buyer has skin in the game. The higher the down payment, the lower your risk. Number two, vet the buyer carefully. Would you lend money to a stranger without checking their financials? Probably not, right? Ask for a buyer's credit report, financial statements, and business experience to assess their ability to pay. Number three, structure a shorter loan term. Don't stretch payments out over 10 plus years. A 3 to 5 year term is usually ideal, keeping risks low while still giving the buyer manageable payments. Number four, charge interest. Don't offer 0%. This isn't charity. You're taking a risk. So charge interest just like a bank would. Rates typically range from 6 to 10%, if not higher, depending on risk. Number five, secure the loan with collateral. If the buyer defaults, what happens? You need a security interest in business assets, personal guarantees, or even a lien to protect yourself. Number six, work with an attorney. Seller financing is not just a handshake deal. You need a solid, legally binding seller financing agreement to protect yourself. Work with a business transaction attorney to draft the contract and ensure all terms are clear. Seller financing can be a game changer when selling your business, attracting more buyers, increasing your sale price, and speeding up the deal, but only if you structure it correctly. Get it wrong, and you could be chasing payments for years. If you want to avoid costly mistakes, we put together a video on the top 3 biggest mistakes sellers make when selling their business. Click the link below and watch it now, and I'll see you in that video.